Hey, what's up guys, Michael here. In today's video I will be talking about the strategy that I again recently stumbled upon on the internet, and I decided to share it with you on this channel. So this strategy fits perfectly in almost, I think, every market, which is FX, stocks, commodities, and even crypto. So I think it is worth noticing this strategy on this channel. And this strategy is a combination of the CCI indicator, which is the indicator that indicates the overbought and oversold zone of particular asset at particular time, at the current time that you are trading it, and two moving averages, which their task is to show you the current trend direction and determine the moments where the trend is emerging and ending. Thus, show us the moments where we should be looking for potential entry levels. One thing that I need to also mention in the beginning of the video is that moving averages, although they work magnificently, we can say, on a volatile and a trending market, they do not work so good at the ranging market, i.e. when the trend is sideways, when the price is moving sideways. That because it generates then a lot of false signals, and therefore it will cause that your stop losses will be hit many times before actually you will place a trade which will yield you a profit. So that is the first thing, and therefore you shouldn't solely rely on the signals of the moving averages, and you should add, in this kind of strategies, you should add two additional filters. In this situation, this is the CCI indicator and the candlestick chart patterns. So as I said, the moving averages will show me in which direction the price is currently trending, and where the places where the price will most probably change its direction, when the trend most probably will end or emerge. So the CCI will help me to determine the specific entry levels. So maybe let's go for the chart. Let's go for the MetaTrader platform, and I will add simple moving averages. So let's go for the insert indicators, trend indicators, moving average, and the first moving average will be the slowest one, which is the 30-period moving average. And the second moving average will be 10-period. Let's make it blue. So as you can see clearly from the chart, when we plot the two moving averages, is that when the fastest one, the 10-period, is crossing the slowest one, the 30-period, it signals that the trend is most probably changing. So for example, here we had the crossover from the bottom to the top, and it signals that the trend changed to the upside. And in a second ago, you see the opposite situation, when the price changed, when the trend changed from the upward movement to the downward movement. So as you can see, there are also situations like this, when you have a very short sideways move. This is a flag pattern or triangle. We should also measure it specifically, but it doesn't matter right now. As you can see, it crossed one time, second time, and those are the moments where the moving averages doesn't work so well. But therefore, yeah, then we see that it did signal the upward movement eventually. So as I said, in this kind of strategies, you need additional confirmation. In this strategy, there is the CCI, as I told you previously, and you shouldn't add too many indicators. I think that too many indicators will give you too much headache to determine whether it is a correct signal or not correct signal. And in fact, I made a video which you could browse through the LiteFinance channel. I made a video about a strategy that is using many indicators, but in the end you are listening to the correct signals of at least 3 indicators out of, for example, 5 or 6. So I think that especially for the beginner traders, it is very important to keep your strategy simple and keep the rules simple of the trading regime. So now let's add the CCI indicator for this chart and briefly explain how it works. It will be the oscillator commodity channel index. Yeah, let's make it dark orange. And most important also thing that you should change the settings. The period by default is 14, but it should, for this strategy, it should be set on 7. Hit OK, and it will appear down below. So the most important thing, as I said, it shows the overbought and oversold zones. So this is the overbought zone, which is above 100 level, and this is the oversold zone, which is below -100. And these are the two sections where we are interested in signals that the CCI gives us. But okay, let's delete that. This is the Euro-USD currency pair, and another thing that you need to have in mind is that the higher time frame, the better. I am talking about that every time that on time frames lower than M15, M30, the market noise is very, very misleading, and therefore you will receive too many false signals that could potentially yield you a significant loss before you actually set a profitable trade. So let's go and check some examples. This is, a real-time chart, and I will just scroll down to the left to check examples. This is an example for a buy signal, and let's discuss that in detail. So, as you can see, the first thing is that the 10-period MA moving average needs to cross the slow moving average, the 30-period. And after this happened, the price should reverse to a 30-period moving average. And after that happens, you need to look for the signal from the CCI. So we are looking at this situation, this moment right here. So when the moving average crossed to the upside, signaled that we think that the upside movement will begin, the price reached the slowest moving average, and the CCI is below -100 level, which is in oversold zone. So the signal for us is to first, either we see that the price, first thing is that, of course, the CCI needs to break out of this oversold zone. So for example, in this red candle, it was already out of the overbought zone, and we can clearly see that on the blue candle, which is the green candle for most of you, or white candle, we could enter a trade. So the potential stop loss in this situation would be, of course, over here, slightly below the recent low, which the price made, which is here. And for the take profit, it is a very, very discussable matter, because the author of the strategy didn't say quite exactly where to put your take profit level. And as I said in the previous videos, also I would not use the trailing stop loss, because most of the time it doesn't work correctly. In this situation, when the movement was very smooth, it would work out, but when for example, here moved, there was a bigger reversal, bigger like a correction to the overall move. It could potentially, when your stop loss would be very tight, it could potentially, just trigger your trailing stop, and then, go further to the downside, and you would miss out on all of the profits. But okay, let's continue to this example. So overall, what I am always recommending is to set use the risk reward ratio, which is minimum 3 to 1. So in this example, if we had situation like this, for example, we entered here. So now let's measure it again, at best with the rectangle. And then, okay, it is 1, 2, 3. And most of the time, as you will see, we will check other examples. Most of the time, 3 to 1 would be even not enough profit, that we would be missing out on bigger opportunity. So what is also important in any strategy, that before you will actually trade it on a real market, you need to make a backtest by yourself and see if those rules are, you know, fitting your trading approach, if you are, you know, feeling it, because it is also very important if you understand the rules and you can if you know how to apply them on the market, and you will check the results before you will actually, for example, lose money, because, you know, most likely you will not understand the rules. But here is this is the thing that you need to have in mind, that before risking real money, do the backtest and make you know, on a demo account, or at least, you know, check on a paper trading on a real account. So as you can see, a 3 to 1 risk reward ratio worked out here very well. We could even take twice or 3 times that much, but hey, we are just discussing the strategy and not making a backtest. The backtest I will make and I will share it with you also, but on Instagram and TikTok. So be sure to follow LiteFinance over there too, because I am sharing stuff like the backtests of strategies that I am testing on the on YouTube channel, and yeah, and many other things. So you can find me also over there. So be sure to check LiteFinance also on other platforms. Okay. So now let's check an example of a sell trade. So we didn't have to also look that far from the long trade. So as you can see, we have the situation where the slow moving average is crossing, the fast moving average is crossing the slow moving average, the 30. The price went down, it backed up and touched the slowest moving average. So now we should look for the CCI shapes, the CCI, and what CCI did. Let's take this marker. Okay, so what CCI did, when the price reversed, it didn't touch the line yet, but it went out of the overbought zone, therefore giving us this confirmation. The price gave us another confirmation. We saw also the engulfing candle, which is additional signal for us that this particular case and this particular example is a good entry moment. So what we could do, enter, for example, here, or even a bit higher. It doesn't matter. It would just, you know, it would matter just of your personal decision. Set stop loss a little bit higher of this price. I am always, when you are trading intraday charts like 1 hour, 30-minute time frame, 15 minutes time frame, I am always adding the spread plus 1 pips, a spread commission plus 1 pips to, you know, have that adjustment as for the market noise. It depends on the situation. So now let's measure the 3 to 1 risk reward ratio, and let's insert another shape, another rectangle, 1, 2, come on, and 3, so more or less. So this example was profitable. Maybe now let's check an example which would not be so profitable. Okay, so I have right now the example of a losing trade. So let's check this out. This is a long trade example. We have the crossing of the fastest EMA to the upside, moving average, the price went up, up, up. From this moment, it reversed to the slowest moving average. The CCI was below -100, so it was in oversold zone. Therefore, we could conduct a trade somewhere over here, right on this red candle, or at the closing price somewhere over here of this blue candle. So this would be our entry level, and our stop loss would be, yeah, from the previous price, from the previous example, it would be somewhere over here. And look what happened. The price went up a bit, but then it reversed and make the lower low than this previous one, and therefore over here our stop loss would be triggered. So as you can see, this is not a perfect strategy, and you need to watch out for those signals. But as I said, if you will be trading higher the time frame, the more accurate those signals will be. And you can always use many assets, since the higher the time frame, the lower amount of signals there will be. But as I said, you can always use a couple more assets to compensate that loss in number of trades. So let's again summarize. We are using 10 period moving average, 30 period moving average trading on a higher time frame, higher than the 15 minutes or 30 minutes. Adding the CCI indicator in settings, we need to change from 14 to 7. And the rules are as described in a second ago. So I hope you like this video. As always, I will remind you to follow LiteFinance on Instagram and TikTok. I am posting also over there, so I will repeat myself, but yeah, this is important. And follow this channel for more content like this. So thank you for watching, take care and goodbye.